What's going on, guys? Ivan Simental, your mortgage advisor. Today on the Mortgage Reports podcast, we are going to be talking about mortgage insurance and what is mortgage insurance and should you have mortgage insurance. So before anything else, thank you so much for tuning in and listening to the Mortgage Reports podcast. If you are enjoying the content that we have been providing to you, please hit the like and subscribe button and share it to a friend or two or a family member. We would greatly appreciate that. What is mortgage insurance? Mortgage insurance covers the lender in the unforeseeable event that you stop making your mortgage payment or you just foreclose on the property or anything that has to do with you not paying the mortgage. It protects the lender and the lender is fully covered. But the downside is you are still responsible for the debt. That is, in a nutshell, what mortgage insurance is. And in today's episode, we will be going over the different types of mortgage insurance on specific properties, depending if it's conventional, if it's USDA, if it's VA, if it's FHA. So we will be covering that in today's episode. So the only way that you can really avoid paying for mortgage insurance is if you are purchasing a property and it is a conventional loan and you put 20% down. Then that is when you do not have to pay mortgage insurance. Why? Because the bank says, okay, there is enough down payment here that if in the unforeseeable event this person stops paying it, we can sell the property and recoup our money. So that, in a nutshell, is kind of what the logic is in the bank's head as to why the 20% rule. So 20% rule is the only way that you can avoid paying mortgage insurance. But there are some tips and tricks that I will go over with and explain to you on how you can also avoid paying mortgage insurance. Different types of mortgage insurance. So we have PMI versus MIP. What is the difference? Why are there two? Why do we have these types of mortgage insurance? Well, the first one, PMI, is for conventional loans. Private mortgage insurance is what PMI stands for. So like I said, if you do not put 20% down, you are responsible for paying that private mortgage insurance. So with a conventional loan, you can go as low as 3% down all the way up to whatever percentage obviously you want to put on the property. Now, you can pay for the mortgage insurance up front if you'd like. That is always an option. Depending on the percentage is what you will be charged for the upfront mortgage insurance premium. So that is an option for you to avoid paying it, but is it recommended? Not necessarily. Can you do it? Yes, you can, but it's only recommended when you put 10% down because the difference is very minimal of the remainder of the mortgage insurance premium. Now, if you do not put 20% down on the property and say 2 years have passed and you've gained enough equity where now you have the required equity in your property to avoid paying for mortgage insurance, you can always call your servicer or the bank where you obtained your home loan, and the call will go something like this. Hello, bank. I now have enough equity in my property where I would like to remove my private mortgage insurance. The bank will then say, all right, awesome. It looks like you do have enough equity. We are able to remove that now. So they'll remove it and you'll see it on your next billing or two cycles, depending on the company. Now, if they don't think that you have enough equity, this is what they'll do. All right, great. You have to pay for an appraisal. We will order an appraisal. Once we get that back, we will then determine if you do actually have the 20% or the equity required for you to remove the private mortgage insurance. That is how you can get it removed if you do have a conventional loan. Now, let's talk about mortgage insurance premium. This is for an FHA product. This is required for all FHA loans, no matter how much money you put down, no matter what you do, it is required. And the upfront premium is 1.75% of the loan amount. That is what you will have to pay. And the annual premium ranges from 0.45% all the way up to 1.05% of the average outstanding balance over the year or every year. Now, here's the trick. The only way that you can remove your mortgage insurance premium if you do have an FHA loan is if you put 10% down or more. That is the only way to get rid of your mortgage insurance premium without refinancing your property into a conventional loan. So again, the only way to remove your mortgage insurance premium in an FHA loan is if you put 10% down or more, and on the 11th year, you are able to remove it. 11 years, people, 11 years. Now, on a USDA loan, they're obviously 0% down. On a USDA loan, you are not required to put anything for the down payment. Of course, you know you will be responsible for the closing costs. We've talked about this before. They do have something that is called the USDA guaranteed fee. Now, what is this? So the upfront fee is typically around 1% of the total loan amount. And then every year they will charge you 0.35% of the outstanding balance. That is essentially their mortgage insurance or private mortgage insurance for the USDA loan. So they have their own terms, and this is what it is. It's the guaranteed fee. That is what you have to pay. Some banks I've seen even charge up to 2% upfront. It totally depends on the institution, but they do typically charge anywhere from 0.35 to 0.40 annually, and that you will be billed for. Now, the federal government does evaluate these every year, and they can change from year to year depending on what the federal government determines is the appropriate fee for that specific year. So depending on when your loan closed, that's when your fee will be fixed for the remainder of the year, for the remainder of the life of the loan. So now let's talk about VA loans. VA loans have something that is called a VA funding fee. And the VA funding fee can range anywhere from 1.4 all the way up to 3.6% of the loan amount. So this fee is included on top of your outstanding balance. You will see that when you receive your closing disclosure. You'll see a VA funding fee, and depending on your loan amount, it can range anywhere from 5, 10, I've seen 15,000. Of course, it totally depends on your loan amount, of course. So these loans in a nutshell are what you will have in regards to mortgage insurance, private mortgage insurance, the VA funding fee, the USDA guarantee fee. These are the fees that you will have to pay throughout the loan, depending on the specific type of loan that you do have. So remember, the only way that you can avoid paying private mortgage insurance is if you put 20% down on a conventional loan, or you buy it out up front, of course. But 20% down, and if you do not put 20% down, then of course we have to wait until you obtain the required equity so that you can call your servicer or refinance and get that mortgage insurance taken off. Now, if you're going to have an FHA loan, remember, you will need to put down 10% down or more and have them remove it on year 11 is when you are eligible to remove your mortgage insurance if you choose not to refinance into a conventional loan. And if you are using your VA or a USDA loan, remember they have their own upfront fees and yearly fees that you will be responsible for. I hope I've answered some or all of your questions in regards to mortgage insurance and private mortgage insurance and how you can avoid paying for private mortgage insurance or mortgage insurance. If you have any questions, leave them down in the comments. We'd love to answer them and dive in a little bit deeper in the comments or create video based off what you leave for us in the comments. Thank you so much for tuning in. Have yourself a wonderful rest of your day.